Okay, so going forward, as once the market bounced out of that cycle extreme, we have a tweezer. Again, this is called a tweezer. We have a very strong negative candle and a succession of very strong positive candles. So this is just like a vice or a tweezer. Someone may say we had a vice here and the market went down, but there was no cycle extreme. There was a cycle extreme here. We're having consistent splatter momentum here. You have to take a very close look at the momentum cycles. Now, the fact that we have a cycle extreme, this really qualifies for a tweezer. What this means, the market is not really gonna be dropping below that neckline anymore. You're really seeing a double head, inverted, of course, double head. What we're doing now is the shoulder. Remember, this structure here was a wedge. It tried to break higher and failed. The structure in A, B, red, C, D, red, and E in red is a wedge. Tried to break higher, didn't even make it to the neckline and failed. Did a tweezer, all right, very strong cycle extreme. We're having the same structure again. We're having another, this wedge here on the left. We're having another one on the right below the neckline. This time it's going to break out higher. It's not going to fail. It's supported on a level 1. It's supported on a tweezer. It is supported on positive momentum on the 1 hour. It is supported on positive momentum on the 4 hours. It is not going to fail. Okay, so let's take a look at the internal segregations. Of course, this appears to be an ending diagonal. There appears to be a 1 and a 2. Here is an internal 1 and a 2. Even the internal segregate 1, 2, 3, 4. High degree 3 at the neckline. This is a correction 4. At the most, it's going to test the top of that level 1. Market is a buy at 129.83, 130 in order to allow for some, of course, spread. They call it spread, I believe. Okay, so we're buying that level, 129.83. We're buying 129.9. We are buying 130. You just want to have a hedge. Again, you don't need to stop. The hedge is very close to the market. It's just to show that in reality, if you fall below level 2, then all of this is not correct. What we're looking at is as a structure would have reversed, literally become a double head and moving lower on any new bearish fundamental. But of course, if we're trading and we're going to be buying 129.80 or 129.85 or even 130, we cannot have a hedge at 129.40. We're inviting the market to simply open that position, and therefore we'd want to have a hedge below the head or as close to below the head as possible. You're looking at 128.80. So we're going to take this lower at 128.80 would mean that it is really at a neckline. That here is 128.67 and 128.80. It means we just take this a bit lower, just at the neckline, even below this point in particular, or this point in particular, below the tweezer formations at the top of that shoulder. Okay, so where does this take us? Of course, well, it would of course take us to break out of that neckline. We're looking at once that wedge completes. We only know it's going to complete or not, or if it has completed or not, by looking at short-term momentum on the 15 minutes, of course, and on the half-hour chart. So if we still have negative momentum on the 15 minutes and half-hour charts, then yes, we can get to see these corrections down to 130 and 1.2995. If we are beginning to see reversal or good positive momentum on both, then this wedge is about to break higher. We make the purchase accordingly or buy accordingly. Takes us to 130, 160, right? This is of course 161.8. Most probably it's 161.8 or 200% because this appears to be a zigzag. That 3 here does a 4, bounces at the level 1 and that green arrow. Of course, looks like a zigzag already. There's a kind of a flag here and market moves higher. All right, so we go live, we investigate. Now we're focused, we know what we should be looking at. We investigate the correction in that wave 4 on the 15-minute chart. We investigate the momentum on the 1 hour and on all the relevant time frames. So we first want to look at the momentum. So on that 30 minutes, there's very poor positive momentum. On the 1 hour, it will be better. Good positivity. And of course, on the 4 hours, it is very positive, excellent. And therefore, this is a cycle 3. I believe everyone understands what is cycle 3. And before we go into that, what is a cycle 3 and what is not cycle 3. Let's take a look at the entry first. Now we're looking at the 15 minutes. What kind of corrections are we going to get? Very poor dismal negativity. And on the 5, we have another cyclic stream. So the only one that can get segregated is that 5-minute chart. Because we're having negative momentum on the 5 and the 15, so the flow is down. We always hear that term, you trade with the flow. This is what it's really all about. These two smaller cycles. We're all very small, short-term retail traders. If you trade with the flow, you're always good, seriously, and you're always making money. The only problem that occurs is that we traders are always greedy. So we are trading on a 5-minute chart and a 15-minute chart, and we're looking at 60-point profits. Of course, if you're trading on a 5 and 15-minute chart, you're looking at a 15-point profit. If you trade with the flow, you always get that 15-minute profit if you're using a 5 and 15-minute chart. That is one of the main reasons why many retailers do not achieve good profits. If you're going to trade with the flow on the 60-minute chart and the 240-minute chart, if you have double positive momentum cycle on the 60 and the 240, we traders are too impatient. You just can't wait. We can't wait. You have to wait for another 36 hours to make good profits. You just close out too early, or you are just too impatient, and therefore you still don't make profits. That's why using a degree 3 or cycle 3 strategy, we are using 60-minute chart, 240-minute chart that are both flowing together. We go with the flow. Both of them are pointing in the same direction. We buy off the 15 minutes. Anything you buy off the 15 minutes, especially the pivot at S1, you just let it run until the next day is going to be at R1 and you're making profits. So it all relates at the end of the day to really the same thing, more or less. Okay, so let's first relate now the correction. We know this is going to be the only two negative momentum cycles that we're seeing are the 5 and the 15. We know this should bottom at the most at 130 or 129.80. We keep saying if you're going to trade it, you label it. So this is of course a 1, 2, 3, 4. It's trying to do a 5. There is a very timid, there isn't really. This is just a wedge. It must be a wedge because of course we keep seeing wedges all over the place. Maybe our eyes are playing tricks on us, but we really are seeing wedges. We have a wedge here. So it's just a fraction. The market is simply repeating what it is doing, and you'd expect a wedge. All right, so even in this wedge, we have a label of 1, 2, 3, 4. You're about now to finish 5, but not yet finished. So long as you're having negative momentum, the move is not yet finished. We're having negative momentum. So that 5 can still, internally, you can see it's actually doing a very small internal 1, 2, and a 3. It can take you all the way down to 130.19. It can take you all the way down to 130. I believe that's it. Of course, we know that we shouldn't really go below 129.8. Here it's showing at 129.72. Good spike into that. Okay, so we carry on with the segregation. We just 5.